Welcome back to another episode of the Tailored Property Wealth Podcast. My name is Casey Taylor. I'm the host of the podcast. And in today's episode, we're going to be doing a little bit of a monthly wrap for October, just in what's going on in the property market and a couple of other bits and pieces. We are posting this one a couple of days after when we typically do post. We've got a couple of things going on in the business at the moment. So unfortunately, a little bit late to post, but nonetheless, we will still be getting them through every single week. So let's get into it, right? Let's talk about some of the property market data from CoreLogic for the month of October. And if we're looking nationally, it's kind of not pumping along as much as you would think. But then once we look at those couple of markets that are performing, they're still going very, very strong. So let's take a look and quickly go through the monthly stats. So Sydney dropped 0.1%. Melbourne, 0.2% drop. Brisbane increased 0.7%. Adelaide increased 1.1%. And Perth out in front at 1.4% growth. Hobart grew 0.8%. Darwin corrected 1%. Canberra back 0.3%. So, look, what we predicted for 2024, Brisbane, Adelaide and Perth were to perform, and they're continuing to do so. If we look at just those three cities on a quarterly basis, Brisbane has grown 2.4%, Adelaide 3.7%, and Perth 4.1%. So Perth first, Adelaide second, and Brizzy coming in third there at the moment. So they're still performing strongly, and when you're kind of looking in those areas in the more affordable locations, they're actually performing a lot stronger than that. So it's just prices are just still pumping. It's crazy. Some of the growth that we have seen this year in those marketplaces, and where we were kind of purchasing properties for 500K 18 months ago, they're now ticking over to the 700,000. So it just shows that importance of, if you're sitting on the fence waiting for rates to drop a little bit to save 5-10 grand a year, just makes zero sense when prices are going up 200K and you've just got to borrow so much more to get that exact same asset, exact same quality asset. Just because it's 200K more doesn't mean that the quality of the asset has changed, which I always bang on about. Sound like a broken record, but that's the reality that some people just unfortunately don't get. So if we then look at the annual figures, right? So Sydney has grown 3.7%, Melbourne has gone backwards 1.9%, Brizzy's grown 13%, Adelaide grown 15%, and Perth 22.6%. So for those three top performers, double-digit growth in the last 12 months. So really consistent. And then, like I said, again, if we're looking back at some of those more affordable locations and strategically where we target, the price growth is can be a lot higher than that. So, yeah, that asset selection is key. Some areas that you've purchased in, you could have lost money in the last 12 months, but in the right areas, you can have made 20%, which is just massive results, right? If you're out there and you're investing for financial freedom. Now, listing levels are improving a little bit. So Perth has seen some listing increases, Adelaide and Brizzy as well, but they're still about 20% below that 5-year average. So still undersupplied. But yeah, we are seeing a little bit more stock, but then it comes back to, is that stock quality stock, and can we get it under market value, et cetera, et cetera. So that's what we want to focus on as investors. You don't want to go out there and you don't want to just purchase something just to get into the market and overpay, right? It's a matter of getting that quality asset at a good price, get that equity injection from day one, and then with that area prime for growth, you're just setting yourself up for those further purchases. Now, right now, we're in this interest rate environment where it's at its kind of peak, and it's not a matter of if we're going to see rates reduce, it's just a matter of when. It's hard to predict because I don't even know if the RBA knows. We know that over the last couple of years with what things have taken place. But just a little bit of food for thought is, if over the last 12 months rates have been higher. And in the last 2 years, we've seen rates increase, but some of the performance that we've seen in those marketplaces just continued to churn away. What is going to happen in some of those marketplaces once we see rates reduce, money's that little bit more affordable, and the herd come back into the marketplace? That demand is going to increase. We know fundamentally Australia-wide we have a supply issue, and it's just that pressure cooker for growth. So it's an exciting time as a property investor if you can take action now. And we're just seeing it in the business as well, is there's a lot of investors understanding that at the moment. And yeah, we're just pumping later on in the year, which typically sometimes can be a little bit slower, right? People are going to wait for the new year, but there's just a lot of people taking action right now, trying to get in before we start to see those rates reduce and just a herd flooding back into the marketplace, competing with more people, et cetera, et cetera. All right, so cool. Let's go through just some bits and pieces from like rental yield, et cetera. Okay, so annual change in rents for houses. We'll just go through houses. That's all we focus on. So Perth, 9.4% growth. Adelaide, 6.7% growth. Hobart, 6% growth. Melbourne, 5.4% growth. Sydney, 5.1% growth. And Brisbane, 4.4% growth. Canberra, 3.2%. And then we've got Darwin, 2.1%. Doesn't really matter who wants to live there. Sorry, Darwin. So the increase in rents has actually slowed down, right? And this is something else that people don't understand. And what has taken place this year is as capital growth outperforms rental income growth, your gross yield drops. So when you're purchasing 12 months ago, it was pretty easy to get that 5% gross yield in some of our marketplaces. Whereas now that same marketplace was getting the 5%, kind of dropped back to like that 4 to 4.5%. And that's simply because of the performance in the price growth compared to the rental income growth. So counterintuitive, right? Yes, you've waited 12 months and rates still haven't dropped to save money. But now if you're purchasing, you have to borrow more for that same asset and you're not getting that same return to help hold the property. So I always say get into the market as soon as possible because it just makes sense. And if you're trying to help your cash flow, action helps a lot. All right, so those gross yields, right? So Canberra 4%, Darwin 6.8%, Hobart 4.3%, Perth 4.2%, Adelaide 3.7%, Brisbane 3.7%, Melbourne 3.7%, and then Sydney at 3%. So the combined capitals, right, for the gross rental yields from 2020 dropped a little bit, and then they started to increase, and they kind of overall have sit stagnant. So gross rental yields on average 3.47%. But like I said, we're getting stronger yields in those locations, still not sacrificing on capital growth, right? You can get both at the same time. Alrighty, so that's kind of all that we'll touch on there at the moment, just with the price growth, what the yields look like a little bit from that point of view. And we'll just touch on some other bits and pieces. We've mentioned obviously those listing levels, rental income growth. Vacancy rates are still pretty low across the board. So I'll just get these up for SQM research. Give me 2 seconds. Here we go. So if we're looking at Canberra, October 2024, 1.7% is the vacancy rate. We have Sydney sitting at 1.5%. We have Darwin sitting at 1.4%. We have Brizzy sitting at 1% flat. So over the last couple of months, slightly dropped. Adelaide, we're sitting at 0.6%. Go to Perth quickly. Now, Perth is 0.5%. Crazy, right? Hobart, it's sitting pretty low too, 0.6%. But we know that marketplace down there, there's a lot of listings at the moment and that stagnation. And for Melbourne, 1.7%. So it varies, right? But some of those marketplaces are still chronically undersupplied. Across an entire metro location, we've got some of those areas sitting at 1%, 0.6%, 0.5%. So chronically undersupplied still from that point of view. We've touched on the issues that's kind of causing this issue with vacancy rates and the rental crisis. We need more investors out there investing to supply the supply that we need for our tenants and renters. And quickly leading into investor activity over the last 12 months. So as per the Australian Bureau of Statistics, investor loans are up 29.5% from a year ago, which I think is pretty powerful, right? A couple of years ago, rates started to go up, the herd started to freak out, and there was a lot of people sitting there waiting for rates to drop, all the rest of it, blah, blah, blah. It's costing more to hold, right? We came from an environment where interest rates were at historic lows. And what happened was it's kind of just adjusted back to a more normal level where on average long term, that's more in line with where it is. And what happens is people just start to adjust. People adapt, people change. They might not have been spending as much on those discretionary things now. They rein those back in. When a couple of years ago, it was a little bit more of a luxury, right? Because money was so cheap. But people start to adjust, and now almost 30% increase for investors. So investors are out there, they're taking action, and they just needed a little bit of time to adjust. So fast forward another 12 months from now, and we see some rate reductions. It'll be interesting to see where that number sits. So yeah, I think that's a cool stat, personally, as a little data nerd. All right, so Reserve Bank of Australia left interest rates on hold for November 2024. Michelle Bullock, she kind of answered things. She didn't really give us much of an indication as to the timing on a rate cut or anything like that. I think they're just holding that close themselves, not really giving us much indication. Again, they don't really know at the same time what they're doing, so it's hard to predict. But I'm kind of thinking it's going to be February next year. Crossing my fingers anyway. It'd be nice to see a little bit of a rate reduction. And that's just me being biased, holding debt. It's just going to help cash flow, right? Which would be nice. So yeah. Cash rate's still sitting at the 4.35. We also last week had the American election. Trump back in as president. Won't really touch too much on that, but it'd be interesting to see what kind of implications come from some of that. There could be some things affected within, I guess, just the worldwide economy. Personally, for me, I don't really read too much into that because I just go out there, I invest, and I'm holding long term. So these small little waivers, whether it's rates, whether it's who's in presidency in another country or even the Prime Minister within Australia, some people are like, I'm going to wait for the election and see what happens, who's in, it's going to affect me. I don't have that mindset. I invest and I'm holding for 20, 30 years. So who's currently in right now does not mean anything to what a property performance is going to look like in 20 years' time and the value of that property. So I really focus on that long-term mindset and just block out all the noise. Anyway, I think that pretty much wraps it up, guys. I just wanted to touch quickly, a little bit of an update, what prices are doing. As we kind of lead into December, I might do a little bit of a prediction like last year. predicted last December that Brisbane, Adelaide, and Perth were going to be the top performers. And I was correct on that one. They've performed extremely strongly at the moment. So cool. Thanks for listening, guys. Hope you enjoyed this update, and we'll see you on the next episode. Bye.